Greetings, everybody. This is Faiz Jacobs, Member of Parliament and also work for Small Business Development. I'm going to take you through a quick presentation on the access to finance. Access to finance, especially for small business, has been a big issue. So, in the next 10 minutes or 10, 15 minutes or so, I'll just broadly take you through a presentation that we did with the development, with the Banking Association of South Africa, with National Treasury, to get a sense of how we're doing with making money more accessible, more affordable for especially small business, micro business, and informal traders. So, let me just start with a quick introduction. I think the International Finance Corporation estimated the funding gap for formal small business, micro business enterprise to be 30 billion rand or equivalent to 350 billion for the formal economy and close to 277 billion for the informal sector. So there's still a huge demand for credit, but many of the SMMEs, the small, micro, medium enterprises, is not served well, and there's a critical gap that requires urgent attention by all players. Government through CISA and CIFA is only disbursing about 2.5 billion rand to small businesses in 2021-2022 financial year. But the Banking Association of South Africa reported that banks loaned and advanced 1.5, 1.4 trillion to companies, mainly big companies, if we must add. So look, there is a big funding gap, and so this presentation will talk about what must we do and answer the questions about how do we make finance affordable. So during COVID, a lot of the business was hit quite hard. The president announced to National Treasury the Loan Guarantee Schemes, LSG, amounting to 200 billion rand to the banking industry through our South African Reserve Bank. The aim of this was to ease the pressure of qualifying businesses with low economic activities to get funding from the scheme. The challenge was that only 9% of this 200 billion rand was used, only amounting to 20 billion rand. So it's very clear it was a big concern that our people didn't use this, and for a number of reasons that I'll explain. So Treasury put this 200 billion rand out to the industry through the Reserve Bank to help ease with the pressure of qualifying businesses affected by low economic activity. And according to BASA, during this COVID period, a whopping 43% of small business were forced to close down due to existing debt, lack of cash reserve, outdated financials, no access to funding relief, and also inability to operate during lockdown. So we said only 9% of 20 billion was used. So approximately 180 billion rand or 90% of the loan support grant was not spent. And so the bank's performance on this was very dismal. And we asked the banks why. So we got a breakdown from the Banking Association of South Africa. They said that they received 50,717 applications. Of that, only 26% of that, which is about 13,300, was approved, and 56% of the applications were rejected by June 2021. Why? Because they didn't meet the eligibility criteria of the bank. The banks didn't meet their risk criteria, and the requested value of the loan was too high, and the banks felt that business couldn't reasonably expect to pay it, and many of the enterprises were not in good financial standing before the pandemic. The banks were required to lend this money to small medium enterprises at a repo plus a fixed rate of 3.5%. At the time, it was equivalent to 7.7%, and the banks were not allowed to make profit from the scheme during COVID, especially. And the margin of 3.5% was used to look at loss that the banks may occur, and Treasury was supposed to help with this. Look, the bank's excuse for not uh, performing optimally was there was red tape. Um, uh, SMMEs had to be in good standing by the 31st of December 2019. But by then, lockdown was really severe and people didn't have the skills and small business didn't have cash flow projection and financial statements, which made it difficult for them to comply. I think the article in McKinsey's website noticed that the banks lack the distribution ability which is required to reach SMMEs at scale. Um, and amongst other things, also to apply for funding, banks required an existing relationship. So therefore, obviously, those that were unbanked automatically was excluded by the bank's model. Um, the scoring models employed by banks was heavy burden on the SMMEs and limited their access to funding. In short, the banks were not creative, were not innovative, were not responsive to the needs. 50% of our SMMEs don't have financial records, such as tax, financial statements, all of those things. So, and banks were required to to ask business, small business, to put down collateral. Many of the SMEs didn't just have that. So, in view of this bank's poor performance, the president introduced in this year's SONA 2022 the bounce back scheme. And so we had to incorporate the lessons of the previous loan guarantee scheme to ensure that access to finance is maintained. The scheme was launched in April, um, and all the banks, the participating banks, had a repo rate of 0.5%. Government will share the risk of non-payment and will be covering first 20% of the expected loss. Um, and this initiative was split into two. It was the loan guarantee scheme. So the first 15 billion of the initiative is designed towards loan guarantee scheme that will cover 20% of small business initial loss. The lender will take the risk for the remainder loans. And then the second part of the scheme was the equity link scheme. The remainder of 5 billion was allocated to the equity scheme we introduced later. Treasury said that this will be disbursed on the first come first basis. Um, Now, let's just break it down. The banks performed dismally, and even in our portfolio committee, the banks gave their own reasons, and we asked the questions. I'll send a link on the bank's response. But in 2021, the banks made a profit of 95 billion rand. So while everybody struggled during COVID, the banks, the six banks, preserved 69 billion as capital to protect their business and depositors' funds. They put in the rest, which is 21 billion, to shareholders, pension funds, foreign investors, to pay empowerment schemes. So that was the major shareholders that was the profit that how they distributed the funds. According to GTAC, which is the National Treasury's arm, they're saying that banks will do an assessment and consider loans up to 10,000 up to the to maximum of 10 million rand and with a maximum turnover of 100,000 rand. Um, and they will be covering this. The participating banks will lend to small business utilizing the scheme as well as their own funds for unguaranteed portions of 79% of the loan, and also DFIs, which is Development Finance Institutes, and non-banks would provide the rest, which would have a floating interest of no more than repo rate plus 6.5%. So how do you qualify for this bounce back scheme? Your business must have a maximum turnover of 100 million per year, registered with the Companies and Intellectual Property Commission CIPC, be VAT registered, SARS, and also meet the requirements of the lenders. And the terms of condition is that repayment 5 years to repay the loan after any interest-free period agreed to by the lender. Payment reschedule lending can be scheduled up to 10 years. Defaulting, if an enterprise fails to pay back, the government will take a 20% of the initial loss. Liquidation, if the SMME goes out of business, the lender will try to get back as much of the money as possible, including the government's portion. So the banks is not obliged to provide loans on this bounce back scheme, and many banks are skeptical about opting in this complex and restrictive processes. The challenge with this thing is that the government is trying to make access finding more accessible, and banks are not coming to the party. And the challenge with this public-private partnership is that I feel, and this is my opinion, is that the banks are wanting to make the profit, but they don't. They want government to deal with the risk. So this triple P is a mechanism where the public sector to shoulder the risk like government does, with a 20% upfront, but the private sector still wants to make the profit. So something's got to give with this scheme. We also not having adequate monitoring M&E, and we don't have the tools to look at both corruption both in the private and the public sector. It lacks transparency and the agreements between them. There's no control, quality, and the risk associated, but the public sector interest is always there. So, in light of this, we asked the banks a few of these questions. They undertook to come back to us because they didn't want to, and we gave them these questions in written form. The Banking Association of South Africa. So, in conclusion, I'll just ask a few of the questions that we asked. So, what are the challenges that banks face, and what progress have banks made with relation to the bounce back scheme? The bounce back scheme was loans to SMMEs were kept at the repo plus 6.5. Given the recent increase, what is the overall interest the loans have to be repaid? In BASA's view, how is the 5 billion allocated to the equity scheme being implemented? The performance of the loans scheme was dismal. Um, what is the banks going to do differently to ensure that the bounce back scheme is a success? What targets have the banks set themselves in support of SMMEs owned by black women, youth, township, rural, and operating to ensure that their operations are inclusive? And how are the banks mentoring and supporting SMEs that have been approved as well as those that have been rejected? Another question I want to ask is how many depositors are coming from that constituency, the township black youth? And so how many of them are being given loans because they're also depositors? And you see consumption, loans for consumption is fairly easy to buy a house, to buy a car. It's maximum profit for loans, but and it's easy for people to get that loan. But loans for productive use, for building businesses, is not so easy. So BASA reports that banks want to lend money to borrowers who meet criteria. However, the context of the legacy of apartheid and privilege position of the banks as an incumbent also matter. In the process of assessing applications for funding, what is the banks doing differently to ensure that the scheme is inclusive and responsive to the inequalities and the legacies in the South African business environment, while avoiding reckless credit? How do banks ensure that 50% of SMMEs in South Africa who that don't keep financial records, especially in our township and rural areas, have access to financial support? And what needs to change in the regulatory environment to make access to funds more accessible for people? The IFC reports that over 300 billion is needed for the funding gap. What are the banks willing to do to correct the situation, to reduce the funding gap? And in the bounce back scheme, the government is covering 20% of the risk, while banks is responsible for the 80%. Can BASA explain why in detail, what does this risk sharing mean in practical? And also, given the commercial sector have different goals, how do the banks ensure that risk sharing mechanisms are transparent and protected from corruption? So those are some of the questions that we have, and as Parliament, we ask the banks to come back with a written response. I've shared this video in the interest of creating awareness, creating attention. What I'll do is I'll send a link to the YouTube Parliamentary Committee of the Small Business Portfolio Committee, as well as links to the documents, both the bounce back scheme, the analysis that Parliament has prepared, as well as the presentation of the banks. and also National Treasury's bounce back scheme. I hope this was useful. Thanks for taking time to listen. If you like it, please subscribe and like and share. And hope we will continue this empowerment and sharing. We need to ensure that our people get access to finance, and we build an entrepreneurial culture, especially amongst our previously disadvantaged communities and individuals. For that, I want to thank you for your kind attention. Bye bye.